We're going to talk a little bit, well, not a little bit, we're going to talk a lot about what our outlook is for 2025. And the title of the program is Pragmatic Optimism. I think anytime there's a new year, I'm a pretty optimistic person anyways, but you get a new year, you have a new presidency, whether you love or hating, it's still different, right? It's new, some of the things change, and there's always some hope for some kind of optimism out of something. So we're going to talk a little bit about the economy, and we'll talk about stocks, bonds, we'll talk about alternative investments, commodities, and then last but not least we'll tie it all together and say, okay, where do we think we should be investing right now? Do we like, what part of the market do we like the best? How should we asset allocate things? And what we believe is going to be a positive year. So I'll leave it on that. Maybe not as positive as last year, but we do believe that it's going to be positive. So the title on this screen right here shows that the consumer is slowing, but we do believe that there are some tailwinds, and there's some reason for that. So we believe that there's a lot of what we call pent-up demand for CapEx. So CapEx is really nothing more than business spending. So if you look at this slide, it gets all the way back to 2019, so we're going to go pre-pandemic, post-pandemic, and then into now what we believe is coming forward. So a lot of the companies in the last year, in 2024, made a comment that they really were not going to make any real investments in the economy or into their business until after the election. Because there was a lot of talk about the election. It wasn't exactly a normal election cycle either, right? I mean, we thought we were going to have two candidates. It didn't end up to be those two candidates. It was a different two candidates. So it was really kind of a different cycle all the way around. So most businesses said we're just going to wait and see what happens before we decide to make any business investments. And we're already starting to hear some of those business investments and what they want to do. So we do believe that that is positive. The other thing we think is positive for this year has to do with research and development. There's a lot of research and development, and if we get some policy shifts, maybe some of that will be easier, maybe not. We'll see how that plays out. So this one surprised me when we were doing some of the research, and LPL put this out, and that is here that where some of the economy came from in the last few years came from the 35 to 54-year-olds. And the biggest reason for that is the fact that they are now in their peak earning years, right? So they're their peak earning years, they're also, what does that mean? Their peak spending years. So a lot of the economy was driven in that age group. What I like to say is the millennials that we all complained about forever, right? Okay, really and truthfully are doing something positive for the economy, right? We said they were lazy, they didn't know how to work. There were a lot of comments written about millennials. Probably not as much true as we wanted to believe, but they are contributing to the economy. The other thing that they do is they believe in experiences. So a lot of the money that they spend has to do with having those experiences. So whether there are Disney trips or they are just hiking somewhere, they do believe in spending money that way. So we have seen a lot of money flow to that part of the market. Whether it is airlines, whether it's travel companies, we've seen a lot of money flow in that part of the age. So another thing that happened this past year was inflation, right? It started to come down. I don't know about you, but I'm not sure I feel it yet. I think that when I go to the grocery store, it is still very expensive, and I'm not sure that that's coming down anytime soon. I like to believe they're doing the right things to bring that down, but I'm not sure of that yet. And then the other would be also just dining out, okay, because of food prices. I don't know about you, but I think I probably spent almost twice as much last year dining out. We didn't go out any more often, but because of the cost, it was that much more. So we're starting to see that affect things. This slide here shows the difference between just income, the poorer folks versus people that have more income, right? So we know that more money can be spent on the upper end. The upper end does not feel inflation as much. However, there's some trends that we like to follow when we see the top 20%. So if the top 20% starts shopping at Walmart or starts shopping at Target versus Bergdorf Goodman, or they're not going to the high-end grocery store and buying things. They're now shopping at the Kroger store and the Aldi's, etc. We start to know that that is truly a trend and that the economy is slowing down. It's another sign or another way for us to gauge what's happening in the economy versus, just hearing, well, it's slowing down or this is happening. It's another way for us to look at that and see what is actually happening with goods and services. So yesterday the Federal Reserve said, well, we're not going to lower interest rates. We're not going to raise them, but we're not going to lower them. What their concern is that inflation is coming down, which has always been one of those issues that we have been worried about. We just talked about it, right? We're not really feeling that whole idea that inflation is getting better. We think maybe inflation is probably staying about the same, maybe getting a little bit worse. So as long as the Federal Reserve does not get what they want and their target is 2% on inflation, we don't believe that they're going to change the investment policy there and lower interest rates. They were pretty clear yesterday in their statement that they did not believe that they were going to raise interest rates. In fact, they were going to put more of a pause on it. So as of right now, it looks like we're not looking for another lower part of the rate hike or rate lowering until sometime in June, maybe another one in November. But there were many economists that believed we were going to get more this year. And I'll be quite surprised if we get to it. Okay? I just don't believe that we're going to see that many differences in what's happening with inflation. I think it just takes too long for it to come down. The first part comes down pretty easy. They can do a few things with the economy and make them come down, but this last little bit, it trickles in, and it will take a long time to get that down under that 2% level that we're looking for. So stocks, everybody's favorite topic, right? We all want stock. Start there. What's the new high flyer for the year? It's a fun topic. We're going to make some money, and it makes a lot of fun, unless you woke up last Monday and it looked like the world was coming to an end again, right? The stock market was going to be down 900 points. The bond market wasn't going the right direction. It was chaos, right? So let's talk about a little bit about what happened last week. Last week, really and truthfully, what happened was two things. Number one, we have a company out of China, DeepSeek, who said that they could make AI chips a whole lot cheaper than we can make them here in the United States. Whether that's true or not true, we don't know. But I believe that it was broader than that. I think the AI sector needed to come down. When you start looking at the wonderful 7 stocks that have been dominating the market for quite some time now, most of that has been pent-up demand for AI. Alternative intelligence, artificial intelligence, whatever you want to call it. It's a new universe. We're just starting to look at it. But we had one company that was really very, very good at it, which was NVIDIA. And when you start getting companies that are trading at 40, 50 times earnings, they need to come back down to earth a little bit. And I think that's part of what happened. It was some people took their gains out of those stocks. It wasn't just the idea that there's another company out there that can make this chip cheaper. Because let's face it, are we going to rely on Chinese chips? Are we trying to get away from all the things that we want being made out of China? So I'm not quite so certain. But what it will do is it will drive more competition in that market, which we desperately need. We don't want one company being in charge of everything. So I think it's something that really needed to happen, and I think we're starting to see a broadening out of what's the right places to invest, not all in just 7 stocks. We're going to look at the whole S&P 500 for a change versus just 7. So we are in the 3rd year of a bull market. So the current bull market started in October of 22. And so we are now in the 3rd year. We look at the bottom part of the slide down here. We don't know where the bull market peak is and where it's going to end at. But we know in the first year we were up about 21.4. In the 2nd year last year we were up about 32.2%. So not bad. However, difference in averages. Normally the first year of the bull market is the best at averaging 40%, and the 2nd year is slightly less. So a little bit of a flip-flop. third year normally averages somewhere around 5%. Our thoughts on the market this year is somewhere between 7 and 9% is what we're going to get out of the S&P 500. Partially because we believe in this whole broadening effect. I don't think, you and I can probably start to think about stocks that, for the most part, we grew up with and knew. IBM beat earnings, beat what Microsoft did, beat what several of the other companies did just the other day. Not a company we talk about much anymore, but once upon a time, it was king when it came to the computer world. So those kind of things are going to happen. We're going to see the Procter & Gamble's, the Heinz, all those kind of things do better in this kind of market. Also because they're going to pay dividends. Those kind of companies pay dividends versus the tech companies that pay very small dividends. And anything that has a dividend is going to help us grow a little bit over and above just getting some growth out of that company. So we do believe that we are in the third year of a bull market. We do believe that it's going to be positive. So the other thing that happens is that stocks normally go higher when interest rate cuts start to take effect. Now our interest rates, we had quite a few of them last year. Now we're going to see them slow down a little bit. But still, if we look here that the stocks go up and get higher as the rates come down, we look at 6 months later as the dark line and 12 months later is the gold line. There's only a few times that doesn't happen. In each of those occurrences, there was a recession. We do not believe that there's any recession on the horizon, and we don't even see any rumblings of whether that we're going to run into a recession right at the moment. So if you look at the times that this didn't happen in 81, 01, and 07, those were all recessions, and for various reasons, those recessions did happen. We're just not looking for it now. So Magnificent Seven, as I talked about it a little bit ago, their earnings are good, right? Just had earnings, some of them were good, some of them were bad. Tesla's were awful. No one seems to care. Tesla's still up today even though it had terrible earnings. So who knows? Is it just because he's in front of the president, or have we just always looked past what Tesla's doing because Elon is just kind of out there, right? Talking about things. So what we're seeing in this slide here has got to do with the Magnificent Seven is the gold, and the dark line is the S&P 500. So when we look at earnings, we can see back here in 2023 and going forward, the Magnificent Seven earnings were much, much better than what was happening in the S&P 500. Now we're starting to see it match. And the more we start to see the S&P 500's earnings keep up with the Magnificent Seven, I think the better off we're going to be. We want to see all the companies doing well, and I believe that is starting to show that, and I think it will continue into this year. So signs of exuberance, okay, and discipline, right? What was it, Greenspan made that call famous, right? Irrational exuberance in the market many, many years ago. And I think that's part of what happened last Monday. It was a little bit of irrational exuberance between a new president and a new regime in town, and the idea that we had all this stuff for AI and how that was going to work and what it was going to do for us. I believe that we had a little bit of irrational thoughts going into the stock market. I think it should go up, don't get me wrong. However, we need to be a little more concerned and pay attention to how we're getting those returns. Bonds, my favorite topic in the whole world. As I tell everybody, we haven't got the bond market right in what, 15 years, Linda? I don't know.
It's under 20.
Yeah, it's been a long time since we've gotten the bond market right. So if we, excluding last year, bonds for the last, 10, 12 years have been what? Where interest rates have been zero. Haven't got any money, any return on it. So now we're starting to see a little bit of return on our bonds. So is it a golden age for investors in bonds, or are we just going to get more of a return to the mean or back to the averages of what we've seen before? So yield curve should steepen. So I think if you came to one of these in the last couple of years, we've had an inverted yield curve, which means if you were at the lower end of the stock market, you were doing better than if you invested in the longer end of the stock market when it came to the bonds. I shouldn't say stock market, bond market. So you got more for going 3 months than you did for going 10 years. Now that's changed and it's more normalized, however, it's not quite there yet. So you can see that it's steepening, that the lower end of the market is somewhere, I would say around 4%, just under 4% on the short end, and about 4.5 to 4.6% on the 10-year. Still not seeing too many people want to go into that 30-year bond. It seems to be that the 10-year, 12-year is about where people stay if they're looking for some kind of extra yield. What do we want? We want higher yields, right? We always want a higher yield. So that's part of the demand, part of the reason why we believe that the bond market is still doing what it's doing. So even though the Fed has started to lower interest rates, we are starting to see that it's not coinciding with what's actually happening in the bond market. So yesterday, when the Federal Reserve announced that they were not going to lower interest rates, you would have thought that the bond market would have said, okay, well then yields are going to back off a little bit or they'd go a little bit higher. They did not. They stayed right about the same. Stock market fell apart. They like low interest rates, right? They're going to borrow money. Companies want much lower interest rates. That did not happen. So we think that the 10-year is probably in a trading range somewhere. However, we are starting to broaden out a little bit on our horizon, and we want bonds to be a little bit longer. We have some in the short end, and still doing that money that's less than a year or floating rate, when we know we can take advantage of that. However, we're starting to broaden out and see our bonds go a little bit longer out on the yield curve. So what's the biggest hurdle for the bond market this year? The biggest hurdle is that we have all this money coming due this year in treasuries. $6 trillion of bonds, treasuries, will renew this year. What rate are they going to renew at? That's the biggest thing. Will there be enough buyers for all of our bonds? And then on top of it, we need another $2 trillion just to support our deficit. So we have to be able to come up with $8 trillion in new money in bonds this year. As you can see, it'll back off down in a few more years, but it is a huge year for the bond market. Part of the reason I don't believe we're going to see yields go much more than where they are right now. I think we're pretty much range bound somewhere between 4.25 and 4.75. There's some people believe we can get up to the 5s, whatever. I just don't see it. We would have to have something pretty bad happen. As bad as the helicopter crash was last night, the plane crash, it would have to be more catastrophic, unfortunately, than that to see the bond market go the other direction. But this will be a big hurdle. We'll be watching the bond buys every month to see if they're able, if the auctions are good, and we're able to pre-payroll that at a halfway decent rate. You gotta remember, on top of redoing this, if those bonds were 10 years old and they're being new paper this year, what interest rates were they 10 years ago? 2%? Now they're going to be 4%. So that adds to the deficit because we have to pay the interest on it. So another whole problem with keeping the economy going and us interested in how we're going to get it. So alternative investments. Alternative investments really came about because of the no interest on the bond market. Really and truthfully, that's what came from. Okay? We tried to find a way that we could make some kind of money in the market when you couldn't get any money on bonds. So many, many times we talk about 60-40 mix, right? 60% in the stock market, 40% in the bond market. Well, for the last 10, 12 years, 40% of your money made virtually zero. So if we were trying to balance you out and not get you caught up with what was going on in the stock market, we had a lot of your portfolio that certainly didn't make a whole lot of money. So hopefully we're getting more normalized with that. But there are a couple funds out there that we believe will work. Okay, one of them happens to be a long short. So we believe that there's some losers and winners when it comes to what's happening in the stock market. So you might like Apple stock over IBM or vice versa. So some of these companies will own one and short the other one. And that's really what this is talking about is a dispersion. So you may sell one and buy the other one, and that's what these kind of companies or these kind of mutual funds do, is to try and find a way to make something work. The other thing we like is multi-strategy funds. We don't own too many of them because we like to buy our own and do our own asset allocation. But if you have a smaller amount of money, multi-strategy funds work very, very well. And what a multi-strategy fund means is that you can have alternatives in it, you can have small caps, large caps, and they can go wherever they want to go. So there are several companies out there, most mutual fund companies have something similar, or they may have one, or may have two open in there that can actually find a way to make some money. But you're at the mercy of that money manager. So the money manager is the one calling the shots, deciding what the asset allocation is going to be and where they're going to go to make that money. So sometimes we call those alternatives as well, versus buying 4 or 5 funds to make that happen. My favorite topic, we might as well talk about politics, right? Why not? We're not supposed to ever talk about politics, but there's no geopolitics or any politics going on around the world, right? None whatsoever. So the international chessboard is what this is called. So with this, what our thoughts here is the S&P 500. We firmly believe that you are better off in the United States than you are in a foreign country right now. Big time. Just because I just don't see it, okay? When it comes to politics on top of it, just right now what's happening in our country, right? What are we talking about, okay? Well, we have a couple wars, right? So we have the Middle East. We never know what's happening in the Middle East. That's been going on since the beginning of time. I'm not quite sure that ever should be resolved, okay? Much as I don't hate to see war, okay? We've talked about it forever, right? Then we have the whole Russia-Ukraine thing. And even though we're not at war with China, are we at war with China as far as it comes to investing and where we get our goods, products, etc.? So there's lots of problems around the world. We just happen to believe that you're going to be better off investing in things in the United States that you understand, you know, you're getting good numbers for, etc. So that's why we like the S&P 500. Think about it though, S&P 500, do they just invest in the United States? They're multinational, right? They're all around the world. They just happen to be domiciled in the United States. Commodities. Normally when interest rates start to change, what's the first thing somebody will say to you is, are you buying gold? Okay, well, now we have things called cryptocurrencies and lots of other kind of fun things out there. So we have to take all those into consideration, and not as much money went into gold this time as it has in the past. So gold did very, very well last year. I am not a cryptocurrency person. I don't know enough about it to make a decision on that's where you should or shouldn't invest. I mean, a couple of young guys that can tell you more about that than I can. But we like gold. I just can't tell you that it would be a big portion of my portfolio. I think I would have some. Here's the other reason why. Okay? Commodity prices are softening partially because of China. We just talked about geopolitical things. China, what did they do a couple years ago? They built and built and built, right? They built cities that there wasn't anything there. You know, who knew what was going on there? So we had lots of that going on. And now they can't afford to do that anymore. So we're not seeing the demand come out of China for those kind of products. So as long as that's happening, I don't see that we're going to see a big issue with the commodities. Currencies is another fun thing to talk about. Not well understood. We don't directly invest in currencies. However, when the dollar is strong, one of the things that is very difficult would be to invest in emerging markets. Because what happens with emerging markets, they have to pay things back in dollars. So now they have to have more money because their currency is less, so they have to have twice as much in order to pay back their debt in US dollars. So I do believe this administration will, as they call it, King Dollar, it will stay King Dollar. I don't believe that they're going to let it fall. I think it's going to stay in this trading range. You can see it's bound by the support of the blue line and the resistance on the top line. It's going to stay in that range. I just don't see how it changes. One of the reasons why we do not have emerging markets in our portfolio right now. Some companies do, although even when I look at some of the other money managers, if they have them there, they leave them there all the time. They're at the low end. They're, it's 2% of their portfolio. It's 1% of the portfolio. Where you'll see a high sometimes of 6-7%. Where right now we just don't see